thank you again for inviting me here. I'm going to present today a paper on pension fund flows, exchange rates, and covered interest rate parity. It's a joint paper with Felipe Aldunate, Chida, and Borja Lorraine. And in this paper, we analyze how uninformed flows can have a big impact on pension investments and even on the exchange rate. And we take advantage of a financial advisory firm in Chile that was very influential and had a big impact on pension allocations. And this is actually the second paper that we wrote on that topic. The first paper has studied the impact of those flows on equity markets and fixed income markets. And now in this paper, we study the impact on foreign exchange markets. Now, the conventional wisdom is that currency markets are fairly liquid. They trade around the clock, and they would be immune to non-fundamental investor flows. And traditional asset pricing theories should suggest as well that the price of a financial asset should only change when expected cash flows and discount rate changed. And our paper is related to this recent paper by Gabet and Kojan that that postulates the inelastic market hypothesis, and that shows that prices are highly responsive to fund flows. And as I mentioned at the very beginning, we take advantage of a unique feature in the Chilean pension system to understand the impact of this uninformed non-fundamental shocks on currency markets. Now, just to give a preview of the setting and then as well as findings, we focus on the pension system in Chile. And that system allows individual participants to reallocate their investments across funds with different risk levels. And they have a lot of flexibility to move across different options. And the options are fairly standardized, and they range from mostly equity to mostly fixed incomes. But then the funds, especially the equity funds, are fairly internationally diversified because, of course, Chile is a small country, and therefore they recognize that it's important to diversify internationally. On the other hand, the bond markets are mostly or the bond fund is mostly invested in Chilean bonds, and therefore when investors switch between stocks and bonds, they switch as well between domestic and international investments. And now the unique feature is this advisory firm called Felices y Forrados, and that translates to happy and loaded. Everything that you want to be in life, you want to be happy and you want to be rich, they make those promises. And in contrast to what we think in finance and what we teach our students, they actually focus on short-term market timing recommendations. And over the sample period from 2011 to 2020, when they existed, they actually made 82 reallocation recommendations. And most of those recommendations were moving from investing 100% in the stock fund to investing 100% in the bond fund. And that is tough to justify from a financial economics perspective. Now, we show that those recommendations are largely informative. They don't have predictive power, and the financial advisory firm serves as well as a coordination device across individual investors. They took advantage of social media, and that's how they gained a lot of popularity. And here is the flows driven by their recommendations in 2018. And that's one of the years where they were the most active. And you see the vertical lines here show actually recommendation lines. The dotted lines show times where they said to switch towards equity, and the solid lines are times where they recommend to switch away from equity. And then what the curve here shows is the aggregated pension flows towards Fund A. And for example, 1.5 here would be 1.5 percentage point flow towards Fund A. And the data here is daily. And often there's an autocorrelation for several days, that those flows persist for several days. And therefore, if you measure over a week or two, then those flows are significantly higher than 1.5%. Now, one other thing that you see is that there's a gap every time between the recommendation and the flows. And the gap is exactly 4 days. And that's the time that the funds have to actually pay out those redemptions and to make the reallocations. And that's as well a nice feature, that it's always this fixed delay due to institutional structures. And therefore we see here those recommendations are very important. They have a big impact on the flows, and you can imagine that it's not easy for those funds to manage those large flows. And here actually the largest happened about the middle of the year, where there was almost a 3% outflow in one day. And again, if you add it up over several days, it was a significant outflow. Now this graph here shows for 9 different periods. Mostly they correspond to the calendar year. And you see, for example, in 2017, they were less active and the flows were relatively stable. And only after they started to make recommendations, there were significant inflows and outflows. And the 2018 that I showed before is shown here at the bottom in the middle of the bottom graph. Now we have 3 research questions, and probably the first one you see already that has been we answered that. Do pension fund flows respond to market timing recommendations? And here what the literature has shown is that retirement savers, at least in the US, are generally inert. They don't reallocate their portfolio very frequently. And therefore those results that we find are fairly surprising. Then the second question is whether those recommendations have an impact on the foreign currency movements. And then the third question, we look as well at covered interest rate parity, whether they can lead to deviations in covered interest rate parity. Now, a broader question that we ask is as well about the impact of flows on prices. And then that has been a significant question in financial economics for the last decades. But the problem of that question is that flows are endogenous. They are driven by a lot of factors, and often we don't really know exactly what drives the flows. And that makes inferences difficult of estimating the impact of flows on prices. Now, in our setting, we focus on, or we know what drives those flows. It's this recommendation. Now, as we discuss later on, we don't think that this firm throws coins to decide. It's not completely random, but at least we know that the flows are driven by this firm, and we can then investigate as well what drives those recommendations. Now, the preview of our results, as I mentioned, we show that pension investors make large adjustments to their asset allocations. We show that foreign exchange rates are very sensitive to these uninformed flows. We estimate a price elasticity of 0.8, which is low for the Chilean exchange rate. And then we use as well bank balance sheet and trading data to confirm that those recommendations can have an impact on international capital flows, and as well on parities like the covered interest rate parity that has recently received a lot of attention after the paper by Du, Tepper, and Verdelhan. Now, we contribute to 3 different literatures. Just very briefly, there's a large literature of the inertia of participants in pension plans. Then there's as well a large literature on price pressure in different asset classes. Often this literature has used index changes, and there's as well a recent paper by Pinto Avalos, Bowie and Haidt that analyzes similar questions as what we do. And then there's a very recent literature on deviations from covered interest rate parity, which emerged after the financial crisis. Great. After this introduction, let's talk a little bit more about the institutional setting. The Chilean pension system was privatized in the 1980s. It received a lot of attention around the world, as well. Several economists like Peter Diamond, Olivia Mitchell, Thaler, they have analyzed the Chilean system and have discussed whether that is a model for other countries to introduce to replace their social security system. And in Chile, 85% of working age people participate in the system, and the assets account for 65% of Chilean GDP. Now, the system is fairly highly regulated, and we have overall 7 pension fund companies during our sample period. Those are called AFTs. And they are fairly homogeneous. There are investment limits imposed by the regulator, and each of them has to offer 5 funds, which are creatively called A, B, C, D, E. Fund A invests mostly in globally diversified equity, and Fund E invests mostly in Chilean fixed income. And that means if investors switch from A to E, they would switch as well from mostly foreign currency denominated assets to Chilean denominated assets. And the earlier paper that we have looked at the impact of those recommendations on equities and fixed income, and now we looked at currencies. And investors are very free to switch their investments. And the fund exchanges, and that is a pretty smart feature, are based on the prices 2 days after the reallocation request has been submitted. And that is different, for example, from the US system, that if you buy a mutual fund today, you get the price at the end of the day. But in Chile you get the price 2 days later, and that can potentially internalize externalities imposed by those flows. And therefore the costs of those flows can mostly be borne by the investors that change their investments. As I mentioned, the fund exchanges are implemented 4 days after the request has been submitted. That's more a technical issue, and that's important when we look at the flow numbers. And finally, as well, if switching requests exceed 5% of assets, then the exchanges are deferred on a first-come, first-served basis. The first day, they will exchange 5%, the next day, another 5%. And for example, if outflows would be 20%, they would be having 4 full days to make those allocations. Now this amazing firm, Felices y Forrado, again, they promise happiness and richness. They made recommendations to its online subscribers about the best pension funds. They would send an email. Participants would need to log into the account, and then they need to request their pension fund to make the allocation. It's not that Felices and Forrados would have access to the accounts and they would automatically reallocate. It is actually, there are several steps built in that participants actually would need to make a separate request to their pension providers to implement the switch. But despite that, they react to those recommendations. The service, interestingly, was closed in June 2021 because it was very disruptive, and Chilean regulators imposed capital requirements for firms offering this type of financial advice. And those regulations were very much targeted towards this firm, Felices and Forrados, as well as my co-authors. mentioned. Here is a page from their website. You see they promise less losses. Like this guy here looks not quite happy, but then they offer higher profitability and then overall as well a better quality of life. And it seemed to us after investigating this firm some more that finally the decisions were taken by this little guy here with the green tie on the top right. Maybe that's how they pick decisions, that this little boy was just picking either A fund or E fund. And again, this advisory firm was not the equivalent of Goldman Sachs with a big research division. It was a small startup firm that had as well a conspiratorial view about the financial system, and they thought that financial firms exploit poor retirement savers. And this narrative helped them as well to gain a lot of attention. Great data and summary statistics. Here are the sources. Those are all available, publicly available sources. You can download this data as well from mostly Chilean websites. Here are the assets under management for the different funds. Fund C is actually the biggest, but most of the recommendations were actually between Fund A and Fund E. If we look at equity investment, Fund A has about 78% invested in equities, and Fund E only has about 3.6% invested in equities. But then foreign investments, about 3/4 of Fund A is actually invested abroad in currencies other than the Chilean peso. But then for Fund E, it's only 6%. And therefore, the idea is that Fund E would be safer since it's denominated in the same currency. Now, that is not necessarily true. You might actually think that it might be better to diversify across different currencies, but that's not how the system has been set up. The differences across pension providers are fairly small, and therefore in this paper we just focus on aggregate recommendations. And here's the long list of recommendations, and you see especially at the beginning they just shift from A to E, and then a couple of weeks later they might shift back to A again. Now, first we want to understand what drives those recommendations, and we looked at that as well in our earlier paper, and we don't really find much here. What we look is whether it's driven by stock market performance or the performance of Fund A, by bond market performance of Fund E, then foreign exchanges. In Chile, commodity prices, especially copper, might play a role, and then we have as well inflation, interest rates in there. And pretty much the only factor that we find is actually a short-term momentum strategy. If stocks are up the previous week, then they are more likely next week to recommend to switch to Fund A. And even if we include everything, that actually survives. And then afterwards, it seems to revert back. And therefore, it's a short-term momentum strategy with a reversal after a couple of weeks. But we have to recognize that the R-squares are very small. It's only 1 or 2% of the changes in this linear probability model can be explained. And therefore, maybe this little boy with his green tie might actually play a role, that a lot of those recommendations are fairly random. The second question is to see how would investors have fared if they had followed those strategies. And interestingly, the first couple of recommendations that they made were very successful, because after the first recommendation, when they hardly had any subscribers, then there was a significant drop in the market. And that explains that if you had followed this strategy in 2011, when they started out, you would have outperformed Fund A by 11 percentage points. Now, it's not statistically significant, but economically it's quite big, and that's exactly what Felices and Vargas used to market their strategy. They said, oh, if you had followed us, you would have generated a significantly higher return, and you would have avoided this crash in 2011. But then, and that's exactly why they gained popularity. But then afterwards, most of the years they underperformed stocks, and then as well the intermediate portfolios. And overall, we don't find that they have the crystal ball to predict stock market returns. And actually, one of the few significant results is actually in 2017, where it's negative. But again, of course, stock markets are very noisy, and therefore it's not surprising that we don't find a lot of significance here. Great. The first main question is to see whether those recommendations have an impact on flows, and we showed already those figures. It seems that we don't need regressions here, but it's still helpful to run regressions and control for other variables. The dependent variable is the flow of different funds, like A, B, C, D, E. And then we have here this variable, this recommendation day, and that is a combination of a dummy variable for a day after a recommendation, and then it's combined with the magnitude of the recommendation. And you see the equation down here. For example, that variable is 0 most of the days. When there are no recommendations in the prior 10 days, then this variable would just be 0. But if there are recommendations over the prior 10 days, then actually this variable would be a combination of, first of all, the importance or the magnitude of the recommendation, and then as well of the proportion invested in international equity. And for example, if 75% is invested in international securities, and then if the fund shifts from 100% bonds to 100% equities, then this variable would be 0.75. And on those days, we adjust as well for lagged flows. Now, most of this, I actually prefer not to have this control because it's a lag dependent variable, but then we have as well other controls for returns and flows. We just follow the mutual fund literature, and it's just the change in assets under management adjusted for returns. And here we see the recommendations. The first and the dependent variable again is the flow, and then we have the flow to fund A, to fund C, and then to fund E. The first 3 columns don't have any controls, and the last 3 columns control for returns and lagged flows. And we see first the first 3 days after the recommendation, there's pretty much no impact on flows. But then on day 4, we see a big impact on the recommendations, and it's positive for Fund A. If the Felices Vargas recommends to buy stocks, then there will be significant flows to Fund A and outflows from Fund E. And you see as well that those flows persist for almost a week after that. And at the bottom, we accumulate it together. And here it would be if we move from recommendation of 0% international to 100% international, that would correspond to a flow of 6.46%. Now, in practice, that is too much of a change, but often we see about half that recommendation. And therefore, there are significant impacts. We as well focus on a new entrant, a new pension fund, Modello, and the investors in Modello tend to be younger, and they are more sensitive to those recommendations. Great. Second question is to discuss if those recommendations have an impact of foreign currency. We have a very similar specification where now the dependent variable is the change in the foreign currency, and it is denominated as the Chilean peso relative to the US dollar, and therefore an increase in the currency would mean that the Chilean peso depreciates. And here we see again at time 1 we have a recommendation. Here the recommendation is signed, and that means if it's a positive recommendation, it means moving from fixed income to equities. Moving to equities means as well moving towards international securities, and then we see that the currency increases here, or that means the peso depreciates, and the US dollar relative to the peso would appreciate. And it pretty much happens over the first 2 days, and then afterwards it stabilizes. And the confidence intervals, the 95% confidence intervals, which are shown here by the dashed lines, show that the results become insignificant after about 10 days. And we can as well show this in table form, and we see that the recommendations have an impact on the exchange rate the first 2 days. Now it's interesting, although the flows happen on day 4, it seems that the impact on the currencies is immediate on day 1 and 2. And of course, this could be because the pension funds, they know that those outflows will happen in a couple of days, and therefore they reallocate their portfolios already on day 1 and 2. And just to go back, the magnitude to a typical recommendation is actually 30 to 50 basis points change in the currency, and that is a fairly large change in the currency. We do as well sample splits where we separate between buy and sell emails. The effects occur both, although for sale emails it seems to be delayed by a day. We look at the 2 sub-periods, first half of the sample and second half of the sample, and the results are more pronounced in the second half of the sample, and at that point Felices y Ferrado had much more influence, and therefore that's exactly what we should expect. We look at quarter ends and non-quarter ends, and the main motivation for that is based on the CIP literature that has shown that capital requirements often depend on quarter end balances, and therefore markets, currency markets might be less liquid at quarter ends, and we find as well significantly higher results if the recommendations are at quarter ends. And finally, we kick out the period where the currency was managed by the Chilean central bank, but the results are fairly similar to the base case results. And now if we estimate the price elasticity here, we see that a typical trade size is about driven by those recommendations is about 0.5% of the Chilean money supply. Again, that emphasizes how important those recommendations are. And then the average currency depreciation would be about 60 basis points. And that's what gives us price elasticity of minus 0.8, which is fairly small. It's not quite as small as what we found in equity markets, and it's not as small as Gabay and Koijen documented. Great, just at the end, very briefly, we look at banking balances and covered interest rate parity. If we look at Chilean banks, domestic banks, their currency spot position is actually negative, as you see here in the dashed curve at the bottom. But then they hedge their currency exposure with forwards, and that is shown here at the top with the dotted curve. And overall, their currency position is fairly neutral, and that is because they have to hold as well capital if they take too much currency risk, and therefore they have a motivation to pretty much hedge their currency exposure. And Chilean banks have to disclose the trading volume in the spot and forward currency market by counterparty. And here on the left side, we have the volume on the spot market. On the right-hand side, we have the value on the forward market. And then we divide it into two groups. The dark bars show months where the recommendation is to decrease stock holdings, and the lighter bars are months where the recommendation is to increase A. And we see that banks, the spot market, they actually have they have negative flows when the recommendation is to decrease A, and they have positive flows when the recommendation is to increase A's. And if you look at and for other counterparties, like you see those flows are only when the banks work together with pension plans. For other counterparties, there are pretty much no flows. And in the forward markets, you see that the banks now hedge themselves using foreign entities, most likely international banks. And actually the pension funds themselves, they are not very important here in the forward market. And here is just a schematic, like suppose the pension funds need to buy dollars to buy international equities. They go on the spot market, buy those dollars, and actually the local Chilean banks, they provide them with the dollars. And now how do the local banks hedge themselves? They go on the forward market, and the counterparty on the forward market will be foreigners. And therefore those shocks to asset allocation absorbed by local banks initially, and then as well by foreigners in the forward market. And we see that as well here. Here are now daily imbalances of the banking system. If you focus on the bottom two graphs, that shows actually the proportion of bank equity that is affected, and we see it's actually pretty significant. It's 2% of bank equity after about 10-15 days are changed after those recommendations, and on the other hand, they hedge themselves in the other direction with forward contracts. We show as well the same results in table form. Now, the last part of the paper is on covered interest rate parity. This is a parity that we teach our students. It's an arbitrage relationship that should hold. It should be equivalent to invest in US deposits or to go and buy Chilean currency, invest the currency in Chilean deposits, and then hedge the outcome in the forward market. And without frictions, this arbitrage relationship should hold. But more recently, after the financial crisis, there are deviations from this parity, and those can be shown in the cross-currency basis, and that is just the difference of the previous equation. And when the CCB is not equal to 0, that means that there are deviations from CIP And if the difference is sufficiently large, there might be arbitrage, or there might be profitable investment opportunities. But there are frictions in this market, and therefore those differences are not arbitrage. The way this is the CCB in Chile, actually, surprisingly, in some periods early on, it was positive. More recently, it's mostly negative. And here is the impact of our recommendations on the CCB. And we see that in the first graph, which shows the 1 month CCB and then the 3 months and the 6 months CCB, for all of those horizons, we see that actually recommendations lead to changes in the CCB that are statistically significant, and therefore we identify one reason why CCBs might deviate from zero. Now, what drives it is not changes in interest rates, which makes sense. What drives it is the spread between the spot and the forward market. We showed this as well in regression form. And in subsamples, we see again that quarter ends are particularly important, that the sensitivity to recommendations is higher at quarter ends, most likely due to those capital requirements. And we see as well that in the second half of the sample, this relationship is stronger than in the first half, when Felicity Forrados wasn't as influential. Great. To conclude, and I want definitely to leave time for questions. What we find is that pension savers in Chile react strongly to market timing recommendation, and that therefore it's not true that pension savers would always be inert. Actually, in these circumstances, we probably shouldn't expect them to be too sensitive. And those flows have an impact on foreign exchange rates. We find a relatively strong price, or low price elasticity of 0.8. And then using bank balance sheet and trading data, we confirm that regulatory capital requirements and bank risk-bearing constraints generate deviations from covered interest rate parity. Great, thank you so much, and I very much look forward to your questions.